Hi, welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. Jeff published on Sunday night his weekly playbook, which can be found on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content. Jeff, welcome back.
Hey, Mehdi, it's great to be here.
And it feels like it's already been quite the week, and it's Tuesday morning as we're recording this. So it seems to be a winning market right now, but I'd love to dive in a bit deeper with you. And why don't you kick off with your top down?
Yeah, never a dull moment, right? We have been of the opinion that we're in a counter trend advance off this October 13th low last year. And the counter trend advance is carried a lot further than we thought. Our original expectation was for about a 50% retracement. We got very, very close to that in February, and we thought, well, this is it. Our thesis is playing out exactly as expected, and we got very bearish at that point and advocated, positioning bearishly from a tactical perspective. And once we saw the bank failures in March, we thought, well, absolutely, we're right on the mark, and this is just confirming everything we thought. And then the Fed and Jay Powell said, hey, not on my watch. And they threw another $400 billion log on the fire to stabilize everything. And that worked out for a while. And, since that time, what we think has happened is that what we originally expected is kind of a three-wave zigzag corrective waveform has morphed into what's known as a double zigzag. It's two three-wave zigzags that are bifurcated by an X wave. And we're in the second zigzag of that double zigzag pattern right now. And, our view has kind of been, well, if we have this counted properly, we should be topping somewhere around the 618 retracement. We hit that on Friday at 43.12. Now, there's not a firm, hard rule that, the advance needs to stop at the 61.8% retracement. It could do whatever it wants. In fact, this is wave two, primary wave two of what we expect to be cycle wave A down. And second waves can retrace up to 100% of the first wave. They can't retrace more than that, though. Otherwise, that breaks the count. So it's unusual for that to happen. In fact, it's very common that these retracements kind of halt, in and about the 61.8% retracement level or the 2/3 level. So 2/3 is kind of our next target, then 78.6%. We'll get into the levels in a minute, but it does seem to be the case that sentiment, which is normally something we monitor, but we don't spend a lot of time on until we get to extremes. Well, it's starting to get to an extreme. We've got a lot of evidence building that bullish sentiment is overwhelmingly emotional at this point. And a lot of it has to do with, this idea that AI is going to change the world. We think it will in the next 25 years, but not in the next 25 minutes, 25 days, 25 weeks. We think it's going to be a very long-term road to get to where AI has the sort of impact on global civilization that the bulls suggest at this point. So we continue to be patient. We continue to expect the market to put in its primary wave two high at some point in the not too distant future. And once that is complete, we expect primary wave three down to change that sentiment dramatically and carry the market down to new bear market lows. When that plays out remains a mystery at this point, but our advice to traders, investors, our subscribers is be patient, minimize net equity, play a neutral book if you're long short. And, we think T-bills are a fat pitch at 5.3%. You're collecting, over 50% of the market's long-term historic annualized return. And you take no risk and you got plenty of liquidity. So we would continue to maximize cash reserves there.
It's getting scary now with all these moves on the upside, and obviously you kick off your piece this week, and it seems to be the season to be bullish. Every headline is bullish. Walk us through this.
We found nine major publications that had opening headlines that were illustrative of some sort of form of advocacy toward a new bull market. Are we in a new bull market? This is a new bull market. I think CNN said it's confirmed it's a new bull market. I think that we're reaching that level of emotional involvement, very similar to the peak of the dot-com bubble, where people were, over the moon about owning stocks at any price, especially the stocks that you had to own. Back then, it was Cisco, it was Microsoft, it was Dell, it was Intel, right? Those were the drivers of the market, and they were at ridiculous valuations. Today, of course, it's Nvidia, okay? Also at a ridiculous valuation, right? 84 times earnings, 10 times sales, or more. I mean, I can't even remember off the top of my head. It might be 20. But Apple, of course, is a great company generating $100 billion in revenue every quarter. We can't complain that we don't have great companies in this lineup, right? But the problem is their valuations are at levels that are unsustainable and not in line with their growth rates. I mean, look, Nvidia posted year over first quarter revenues were down 13% year over year. Okay, Apple's I think were down 2.5%. So I think we're not pricing in reality here. I think Microsoft is a good company. Amazon, Google, right? These are great companies. Tesla, I think is way over its skis. And obviously it's got a charismatic leader with, great vision, but, I don't think electric cars are going to take over the world anytime soon, So, we basically price these stocks to perfection at this point, and a lot can go wrong. And I don't think investors have taken that into consideration. And that's really why I feel like, this ebullience over the bull market has probably reached an extreme.
Well, there was always a standard rule in London when I started business that if you got into a black cab on the way to anywhere and he started asking you about stock advice, I can imagine right now every cabbie is sitting there talking about NVIDIA. So that could be calling a top from those types of rules.
I think it's probably worse than that, Mehdi. I think every cabbie's probably started an online service where he's publishing a newsletter explaining how to trade as well as he does.
Black cab trading. Here we go. So you looked at the CNN Fear and Greed Index, and it certainly looks like this is kicking into high gear.
Well, on Friday it closed at 76. Yesterday it closed at 79. The 12-month high is 82, and that was reached on February 2nd. Okay, when the broad market peaked, including the S&P, until it recently broke out. And so our view is that the Fear and Greed Index has basically reached an extreme again, or very near an extreme. And what it's basically signaling is the same thing that these headlines are signaling, that everybody is all in at this point. And, the crowd that was, more bearishly positioned at the outset of the year has now shifted to the other side of the ship, and we're listing to the starboard side now. Everybody's on the bull side.
So, Jeff, you touched on it initially in your opening statement. Let's talk about optimism a bit here. These are some big calls rates. The most optimistic since 2021. This is punchy.
Well, we're just looking at the facts, right? And the facts are that the National Association of Active Investment Managers, NAME, runs an exposure index that basically illustrates the exposure of their constituency, professional investors who respond to their survey, and there's quite a few of them. Last week, when we were on your show, that level was 54%. This past week, it hit 90%. And we'll get another report from these guys on Thursday, and my suspicion is it's going to be even higher. But 90% is about as fully invested as it gets. We've seen some periods that are illustrated in the chart where we've gone leveraged, actually, from participants in the survey. It's rare when that happens. It does happen, though, and those are obviously extremes that are unusual. But when you start exceeding 90% in exposure, it's basically telling you we've got a fully invested professional investment cohort. The flip side of that is the individual investor, right? The AAII, American Association of Individual Investors survey, which comes out every Wednesday, is a notoriously bearish cohort to begin with, right? It's very rare when these guys are bullish. Well, suddenly we saw a big jump of like nearly 20 points to 44.5% of those respondents are now bullish, and the bears have sunk down to 24.3%. The spread has jumped 28 percentage points. If you look at the bulls minus the bears, it's now 20.2%. I mean, that is extremely unusual. It is a huge jump from where we were just a week ago, and it speaks to a massive, embrace of get me in at any price, basically.
My tie's on the beach, Jeff. So let's have a look at the options total put call ratio. This is obviously signaling more bullishness as well, right?
Yeah, I kind of talk about it from the opposite perspective, call put ratio, right? Traders are now buying 1.2 calls for every put. Well, the opposite situation existed at the outset of the year, right? We were very bearishly positioned, right? And, as we started to see mega cap tech take off, those traders started to react. They covered their losses. They unwound that bearish positioning. And now we've positioned quite the opposite, right? We're bullishly positioned. And, my suspicion is we've gone a little bit too far, maybe not reaching an extreme just yet. As we can see, we're toward the bottom of the range of what would normally be kind of a neutralish range. We haven't reached, the break point at, a put call ratio of 0.8 or less, which we would define as complacent. But I would say we're quite complacent at this point. And that, shows up in other measures quite well, specifically the VIX.
Well, I wasn't going to bring up the VIX, but obviously the VIX is still nowhere where we thought it would be. But let's have a look at Skew. Like this, just as soon as I looked at Skew, I'm like, holy Skew Batman, what's going on here?
Well, what we've done here is we've juxtaposed the Skew index above the VIX index, right? And what the Skew index measures is the degree at which traders are expecting a left tail event, right? A 2 standard deviation downside move in the market. And basically, Skew has moved up to a recent high of 158. That's just below its all-time record high of 170, which was reached back in, I believe, late 2021. The point is that when Skew gets this high, and VIX gets as low as it is. I think we closed Friday at 13.5% on the VIX. That reversed yesterday. In fact, believe it or not, the best performing major index yesterday was the VIX. It was up 8.5%. So we are seeing a bit of a reversal in VIX right here. And my suspicion is that the alligator jaws that we're looking at here in this chart are poised to snap close, where Skew breaks down and VIX rallies hard to the upside and unwinds what appears to be an extremely complacent market. And the question is, we entitled the chart Black Swan Alert. Well, a 2 standard deviation downside move in S&P returns would definitely be a black swan, not something that's expected. I have no idea what it's going to be that makes that occur, but the probability that we see some type of an event like that in the not too distant future is very high. It's over 14.45%, which is the level at which is expressed when the Skew is at 145.
So Jeff, you touched on them in your opening statements. Let's dive a little bit deeper into the technicals. What's the short-term Elliott wave look like? And I will get to it on your bigger picture as well. But talk us through what you're seeing now, if anything's changed with these recent moves, and kind of where your picture is, kind of where it is, and where it might change.
Well, Friday at the close, we were thinking that, gosh, we put in what appears to be a fairly bearish candle. We tagged the 618 retracement. We got up to about 43.22, just shy of the August high. We closed down below that 618% retracement, leaving what could have potentially been a shooting star candle, depending what the next session did. Well, the next session was an up candle. It was an engulfing candle. It overtook the price action from Friday and made a new recovery high at about 43.39, I believe, which was above the 618 retracement. Now, what does that really mean? Well, it doesn't mean anything. The 618 retracement, as I mentioned, is not a requirement. We're not required to stop there and reverse, or everything's we have to throw it out the window and go back to the drawing board. The count looks attractive to us. It looks accurate. It looks like wave C of Y is a fractal of wave Y, and wave Y of 2 is a fractal of wave 2. That, kind of a nesting doll effect where you have these fractals, these self-similar patterns that are recurring inside of one waveform, is indicative of a waveform that is coming to its terminal point. And so that's one of the reasons that I believe that this counter trend advance off the October low is near its end right now. Now, could we extend to the 2/3 retracement? Absolutely. Could it go even further, say to the 786% retracement? Absolutely. Those levels are around 4,400 and 4,534 respectively. We've got a make or break on the current count at 43.76. We might revisit that. I might, just pull that off the table and say, let's see what happens here, because I don't feel like it makes sense to commit new capital to the market to chase for another 2 to 5%. Okay, and not that even 5% is even a likely probability, but given that some traders are more nimble than others, we don't want to suggest that they can't do it. So we put these targets out there as potentials, right? And my suspicion is that if we break above 43.76, which is about 1% above that 618 retracement, then we're going to hit 4,400, and 4,400 probably changes our current count. The current count looks like a double zigzag. There's a big wave in the middle that you can probably see, and it looks like kind of an inverted N, and that might be a flat. We've been thinking about that for a while, but we like the current count the way it's tracing out right now. But if we're wrong, and wave A is wave A, and wave X is actually wave B, and it's a big flat, then it would make sense that wave C would equal wave 1, and that could carry to 4,400. So that's one thing that we're thinking about that might be different. We haven't officially made that change, but it's something that we're giving consideration to. But at this point, we continue to believe that we're in the terminal phase, the ninth inning, if you will, of this counter trend advance. And once it peaks, once we see that level, basically kick into, to terminate wave 2, I do believe wave 3 down will be an epic plunge, and it will catch everyone off guard.
So, thank you for running us through that for us, first of all. What about on the super cycle side? Like, that's the really big picture. And has any, obviously this is kind of a zoomed in vision of where we are today, but like from a big picture perspective on the super cycle Elliott wave thesis, do you see any change there, or is that just so big that it really hasn't impacted at this point?
The only thing that would change that is a new all-time high. And, in our opinion, wave 1 down at primary degree is set in stone at this point. And it's just wave 2 up, finding its terminal high. And once that's concluded, we'll see a plunge to wave 3. That'll be followed by a lateral consolidation of some sort to complete wave 4, and then a final move to the downside in wave 5 that will end cycle wave A. We think that target is 2250 on the S&P. That is an area of support that comes into play with a variety of key levels. The 618% retracement of the 13-year advance off the 2009 low. It's a previous fourth wave extreme, and the 200-month moving average all kind of converge on that level. And it's my view that that level will probably act as a significant support and set up for a large degree counter trend advance, one that could retrace 50% of this decline that we're looking for on order of, say, 2,600 points in the S&P. And if we were to see, say, 1,000 or 1,500 point rally, that would be very tradable in our view. And that's what we would like to position to trade. We're not that interested in the next 2 to 4%, if you will.
So let's dive a little bit deeper. Where is the strength really coming from in this bull market? Well, sorry, bull market.
Well, since the beginning of the year, it's been from mega cap tech, right? We've dubbed these the Magnificent Seven, kind of, stealing a line that was invented by someone over at Bank of America that was much more clever than us. But, we're happy to plagiarize where we can get away with it. And, I think that the mega cap tech group, even though it was, kind of waning a little bit for a couple of weeks, we saw a bit of a lull. Yesterday's price action shows that the AI hysteria is alive and well, right? And I think that the mega cap Magnificent Seven is what's driving the bull market, right? It is these overhyped, overvalued, overowned stocks that are very vulnerable if anything goes wrong, because they are priced to perfection at this point. They are responsible for, the New York FANG index outperformance of some 67% year to date, the NASDAQ 100's outperformance of some 34-35% year to date, the S&P 500's performance up over, say, 20-21% now, all driven by these, heavy cap weighted names. These names represent 55% of the NASDAQ 100 and 27% of the S&P 500. So without them, the indexes would be up closer to like 2 to 3%, kind of the broad equal weight versions of the broad market.
That's crazy. The difference between if the equal weight versions. Let's have a quick look at some sectors. Are there any sectors of choice that you would like to lean into right now?
Well, if we're talking about sectors that have performed well, we can look at discretionary last week. It had an extraordinary pop. That was 100% driven by Tesla, okay, which is something like 15% of the index, the discretionary index, and that is why it was a leader. But here's what my observation is right now. If I'm right about the Magnificent Seven, tech and communications are likely going to be laggard indexes, sector indexes in the coming months, right? And we may see this broadening out that we've seen in smaller and mid-cap stocks extend to sectors that have underperformed. Energy could be making a comeback. Healthcare is one where I think we could see some potential. Industrials are already showing very good relative strength. It wouldn't surprise me to see staples join the party as well. And then, of course, REITs, utilities, materials, these are very small sectors, but they've done very poorly year to date. They're very underowned, and this rotation could carry all these laggard sectors higher, while tech and comm and discretionary, because Amazon and Tesla dominate those, could also flag for a while. And that rotation could actually have a very big impact on the actual cap-weighted indexes. Even though we're seeing a broadening out, we may see cap-weighted indexes trade hard down. And that's our expectation. New bear market lows in the not too distant future.
Jeff, really appreciate you running through everything. And, I want to make sure that our viewers realize you can access all of Jeff's content on Substack, on hugeinsights.substack.com, and you'll be able to get access to the top actionable trade ideas that Jeff publishes every week. So I would definitely urge you to check that out. Jeff, I'm looking forward to catching up next week. It seems like every week there's more and more happening.
It's fun for me as well.
Great. And everyone watching, thanks for tuning in, and good luck investing.